Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. We are here on another Market Radar podcast. June 19th, 2022. The year-to-date performances, S&P, we've got down 22.97%, NASDAQ down 30.96%, Russell down 25.75%, Dow Jones down 17.78%. These are all still deep in bearish territory. We've been bearish for quite a while now on all of these. Still in stagflation, still heavy stagflation, unchanged. Total chance of risk off is at 75%, so still hovering very high up there. Deflationary odds creeping up a little bit, not too much. Inflation also creeping up a little bit. So growth could be coming back. Who knows? It still has a long way to go. Deflation is definitely looking like it's on the horizon more so than another risk-on regime, but we'll see if the Fed can swindle their way out of this one again. Let's get on to the economic calendar for next year. So Monday, market is closed. Don't wake up early. Tuesday, we've got existing home sales. Wednesday, Powell's speaking. Thursday, jobless claims, PMI composite flash. Powell speaking again. EIA natural gas report. EIA petroleum status report, and the Fed balance sheet. Friday, we've got new home sales and consumer sentiment. Let's take a look at what ES did this past week. Pretty eventful.
Shitted on.
Yeah, absolutely shitted on. Pretty eventful week. At least the start of the week.
I think this was the start, right? June 13th. Yeah.
Yeah.
Yep.
Yeah, it was a pretty brutal start to the week. And
nice little Fed rally, right? Get everyone's hopes up.
Yeah. Yeah. It was actually nice. So let's talk about the 75 basis point hike that the Fed did.
Yeah.
That was nice. I don't think a lot of people expected that, honestly. People thought the Fed was going to continue with their 50 basis point. Bonds were pricing it in, but a lot of people really didn't believe that.
Yeah. I think that's important to say. So people on Twitter and maybe the people that are macro readers didn't understand that, right? Those that are interested in what is going on, that were watching their screens, didn't understand that. But the bond market had that priced in since Friday's CPI report.
Yeah.
Which was, I believe that was the 10th, right? That was here?
Yeah, it was the Friday, right?
Yep, that was the Friday. So the bond market priced that in here.
Yeah, they knew with that kind of inflation print, the Fed has to do a 75 basis point hike.
Right. So the bond market was signaling 3 rate hikes for June's meeting. Everyone was questioning if the Fed was going to come in at 50. Some people were saying the Fed's going to pivot, which,
that just makes no sense.
Makes no sense.
If you think that, you have no idea what you're doing in terms of macro.
Yeah. All I could tell you is Godspeed. All right. But yeah, so the Fed basically came in and said that they are hiking 75 basis points. That was Friday's big sham. That was a Wednesday's big shams, right? So here we are on June 16th, right? No, that was here. This was the Fed hike, right?
Yeah.
So the 15th, nice little push, and the reason for this push, the big whoop-de-woo.
Yeah, what was that?
That was the interest rate models discounting a 75 basis point hike happening again. Meaning, we had, if you go back in our podcast, you'll remember us talk. You don't have to remember. You'll see us talking or hear us talking about the fact that the Fed is going to hike back-to-back 3 basis point rate hikes, right?
Yep.
That's what the futures were pricing it, or just barely. And obviously, our prior podcast to this one was before the CPI print. So I think, Artie, you and I went back and forth about the potential of us getting a 3 a 75 basis point rate hike at the
Yeah,
next
and
one or
we
two
thought it was
meetings.
pretty likely based on how commodities were performing.
Right. But we didn't think it was going to happen right away because at the time, from my memory, I believe the June meeting didn't have it priced in yet. It was there, but it was not, it was almost there. It wasn't really in there yet.
Yeah,
And Friday's CPI report threw it over the edge.
yeah,
And
exactly.
we spoke about this last week, about this being highly likely. And going into the FOMC meeting, everyone was saying it's not predicted. We basically explained how we have 3 rate hikes priced in.
Yeah,
Now, what ended up happening on the 15th, after the FOMC came out with their 75 basis point rate hike, the futures, the Fed funds futures discounted a 75 basis point hike for the next meeting. What they did was they pulled back from fully pricing in basically 3 full rate hikes. What that means is, let me pull up
okay. So because
let me pull
they
up
did the
this.
3 rate hikes faster than they expected, they're not expecting it anymore for the next meeting,
Well,
right?
um, not necessarily. So the market, see, people didn't expect it, but the market knew it was going to happen. You see here how it says, this is on the terminal on the Bloomberg, uh, the World Interest Rate Probability Monitor. You have the July 27, 2022 meeting at 2.847. This is not fully pricing in 3 rate hikes. You see that?
Yeah.
The difference was it was much high. Well, it wasn't. It was higher before that Fed meeting.
Hmm.
So this discounted, signaling, oh, the Fed might not have to do so much. Well, it's funny because this was at 2.79 or something. It's early Monday morning as we're recording this. So Sunday morning, this was at 2.79, meaning since the futures opened Sunday night, obviously the market's closed Monday. Since the futures opened, this has climbed actually.
Okay. And we
So
we could definitely see that continue to climb,
yeah, we
especially if
think
commodities don't drop.
right, and we think that the chances that we get a 75 basis point hike in July is extremely high. Not because we have tinglings, or we have like
We can feel
flashes.
it in our nuts.
Yeah, yeah, or I just hear a ghost in the room. That's not really what's going on here. It says on this monitor, right? I just look here and it says 2.847. That's what tells me that it's still very likely. If it was 2.3 or anything under 2.5, it becomes really, you have half a, the odds, anything under 0.5 means it's leaning in the other way because you're not going to have half a rate hike. You understand what I'm saying?
Yeah,
Like
exactly.
you can't, like you're not going to get a 12.5 basis point rate hike.
Hmm.
So anything over 2.5 signals, okay, it's high. The odds are rising, or more than majority. The odds have this at above basically above a 2% rate hike, right? You're not going to get 2.8, right? This is pricing in 3 basis points, but it's not full, if you understand what I'm saying. Like if
Yeah,
this was
it's
2
not
point,
like 100% chance pricing it
right,
in, like
right.
guaranteed.
And if
But
this
it
was two,
is two rate hikes is guaranteed.
right. Now, if this was 2.25, I would say, oh, the odds of a 3 basis point rate hike are low. You see what I'm saying?
Hmm.
I'm not giving you, see, look, it says right here, the model estimates 100% of 2 rate hikes and 84.7% of an additional hike by the 7. So literally we have 100% of 2 rate hikes and 84.7%. That's what the second number is. 84.7%, we get that third rate hike.
Yeah. And bottom
I, I
line,
should I should have
if
just simplified it like that. I guess I didn't have to say all that, right?
bottom
But
line,
that's
if
all this
anyone's
is.
trying to trade this, it's not the dip buy in bonds. Like if you have an 84% chance, or well, you have 100, even with 100% chance of a 50 basis point hike, you're not in dip buy bond territory.
Right,
You need to be going into a rate cut environment when you want to have a dip buy opportunity on bonds.
right. And I think that's the best way to put it. You have this situation here that's likely not to unfold, and not excuse me, likely to unfold and not get better. We've been saying this. We're still at Like, just look at this. 7 rate hikes, right? In December, plus 97.7% of an eighth rate hike. So we're pretty much at 8 rate hikes into December. From here, implied rate is going to be 359 basis points. We are currently at one I'm sorry, we're at 158 basis points.
Yeah, so we're going to be doubling, more than doubling
Yeah,
by
more than
December.
doubling. Excuse me, this is the target range, I believe. I'm sorry. So we're at 175 basis points. The effective is 158. So it's still what's that? It's still about doubling, right? Yeah.
Yeah, yeah, it
Yeah.
is.
Yeah. So yeah,
So
we're
that's
still
not a
doubling.
that's not a bond dip buy opportunity.
No.
Like this,
No.
anyone
Now,
trying to do it is going to get slaughtered.
and there's a key to this because this is so let's look at ZN and let's talk about it, right? So bonds are completely they've fallen, and today, instead of going over ZN, we're actually going to just talk about the 10-year yield because it's a little bit more applicable, because applicable to what I'm trying to explain here. So the 10-year yield, let's go back to 15, June 15. You see how it dips? This is them pricing out. This is them thinking the Fed can actually pivot sooner than expected,
Mm-hmm.
right?
Yep.
I don't think, and this is people getting all bulled up saying, "Oh, look, peak in yields, maybe." No, I don't think so. Not yet. We need to really see something happen to confirm that.
Yeah.
The reason I bring up the 10-year is because this is going out 10 years. Remember what we spoke about last year. This is pricing out the rates over a 10-year time frame. 10 years, 10 years of locking up money. What is it going to pay you? This is encompassing all of this, all of this, all of this, all this, all that, way
Yeah,
past all
rate
this.
hikes up until
Cuts up.
2030s.
Yeah. So what can turn this around? What can drastically turn this around? And I'll tell you. The Fed not even getting to here. The Fed, if the Fed is pivoting before these 8 rate hikes, this is the top in the yields,
Mm-hmm. Okay.
right? Then the buy and the bonds appear. And
Yeah.
this is where the key comes in. What's going to cause the Fed to pivot? You would have to have inflation come down, right?
Well, it's not that
Uh,
inflation has to come down. It has to come down hard and become
yes.
deflationary,
Yes.
right?
This is true.
They want inflation to come down slowly and just a little bit because that's the soft landing. But does that ever happen?
No, they're not going
Like
to give you soft landing.
it's
Come
a
on.
whipsaw, you know?
All right,
It's
let me explain this scenario to you, okay? You're above the Appalachian Mountains. You're in a prop plane, okay? And
okay,
you
I see
can't
where this
land
is going.
you can't land. You need a flat surface to land a plane, right? So you're in the Appalachian Mountains. You're in a prop plane, and the propeller flies off the plane.
Okay.
What are you going to do?
Well, you got to glide the plane.
Where are you going to glide it to?
You can't.
You're in the mountains.
There's no flat area to land.
You know what you do? You grab the parachute and you jump out the fucking window, okay? That's what you do. You don't,
There's
this is
no
not
soft
like,
landing.
yeah, there is no soft landing. You have inflate, and you know what? We're gonna bring this in, we're gonna tie this together with the 2-year yield. Well, why is the 2-year yield important? Well, the two-year yield is almost as important as the 10-year yield because it encompasses a lot of the macro policy that the Fed is faced with, right? Because 2 years going out to 2024. Remember this little chart here, this interest rate probability? We're getting all this in there, right?
So
The
essentially, the
reason,
Fed can control this,
the,
the two
the
year.
well, the Fed really controls the 3 month, right?
Yeah.
Because remember the 3 month from now. So we're on what are we? We are June 21st. What's the date? June 20th? June 19th? June
19th.
19th, right?
Yep.
So 3 months from now. 3 months from now, you see how it's not even we didn't even get into the September meeting.
Yeah.
So literally these five rate hikes, 100% rate hikes, are not priced into the model. See, take a look. This is the 3 month, right? The 3 months only yielding 1.63. Why is that? That's because the target rate and the effective rate and target rate, it's in between here. Remember that. We're just barely getting in this rate hike here.
Mm-hmm.
You see that? You see this to 2.3.
Yeah.
let's pull up the 3 month here, and I'll show you.
Well, yeah, so they directly control that, but they also somewhat control, like the farther you go out in yields, the less
The less
control they
yes,
have.
yes, I see what you meant to say. Yeah, exactly, exactly. The Fed has much more control over the 2 year than they do the 10 year.
Yeah.
Well, realistically, the 2 year has control over the Fed if you really want to think about it. I
Oh
mean,
yeah. Yeah, I don't know if everyone
like,
if anyone's ever overlaid the Fed funds rate. They basically just look at the 2 year to know what to do.
yeah, like this is pretty much,
Even just from this, looking at it historically, the Fed's got to hike quite a bit to catch up.
well, yeah, right. So let's take a look at this now. Let's take a look at the 2 year because we know that not historically, the 2 year leads the Fed. The Fed goes to the 2 year, right? So the Fed's got a long ways to go here. The 2 year's pricing in this 3.185. If we
It's
look
like
at the
pre-COVID levels.
I mean, it makes sense though. 2 years from now, by the end, we're 3.72, right? The longer you go out on these rate hikes, the more unconfirmed they're gonna cut. They're gonna be like they're not gonna. What I'm trying to say is, we're expected to have by the end of the year a 3.6% implied rate. Why is this not trading much higher? Well, that's because the further you go out in the curve, the more uncertainty there is.
It's essentially
Which is
bonds not believing that we're going to get all
right.
those hikes this year.
Right, right. Which means while the federal funds futures have it priced in, it's not priced in directly to the bonds just yet. But it will go as time goes on, meaning bond yields can rise, which in turn pushes bonds lower, unless there's a Fed pivot, which is what I was saying earlier. Because if these rate hikes go completely out the window, that shows that the Fed's really going to pivot. This is going to come down hard, right? Because they know like, okay, if we're not going to hike anymore, that means the Fed's not going to just the Fed's not going to just do like sit here for, you see this? They don't just sit. Like, let's go back in time. They don't just, they do, but it's not real. You see how it's not very long? It's what, a
Hmm.
year?
Yeah.
This is where they sit. They love to sit at zero
Yeah, they
for
love
a
to
long
sit at
time.
zero.
But they don't sit up there because they always need to find a way to stimulate the economy. But this is something I want to overlay. Let's overlay inflation, right? And let's take a little bit of a, I'm going to show you something. Okay. And let's go to a weekly chart. And let's look at let's take the Fed funds off. Okay. And let's switch it to 20 year. Make this better. Here. And let's go. Okay. So, for some reason, TradingView doesn't. Oh, 30 year. I'm sorry, guys. I'm sorry. It's late. Um, let's take this off and let's go to a weekly. Okay. So, and can we put this on a secondary index here?
So what are we looking at here?
I'm looking at let's turn off this. I'm looking at inflation with the 30-year bond. Um I'm trying to overlay them correctly. Let me inflation same. Okay. So it's not coming the way that I want to overlay it here. Let me try this one more time. Hold on. No. There we go. No.
That's what you had before.
Yeah, it's not overlaying properly. Well, long story short, what I'm trying to explain to you here is the 30 year. For some reason, I can't get them on the same scale. I'm gonna try. Let me try one. Let me try adding this one more time. Because I really want to show same percentage scale. Maybe. No, this is just not gonna work. Okay. Long story short, if I were to overlay these, um, the inflation here. Let's just new price scale. Uh, my God. Okay. If I were to overlay them, I'm sorry about the delay there. The 30 year likes to trade above the inflation rate. Okay? The 30
Okay.
year likes to trade above the inflation rate, and I think
So it's like if you're locked into a 30-year bond, you're always beating inflation. Well, you should be.
well, yeah, let me see. I'm gonna pull it up on here because I know I can pull it up on here real quick. Sorry about this, guys. Um Okay. Um,
For anyone that doesn't have experience with the Bloomberg terminal, for something that's as expensive as this, it's very, very not user friendly.
yeah, it's pretty stupid to be honest
Yeah,
with you. Like
like
it's not.
it has a lot. It has a lot for sure, but it's kind of a pain in the ass to use.
Right here. This is what I was trying. All that bullshit. I'm sorry, guys. This is literally all I wanted to show you. Let me change the color to this so it like we'll change it to orange. CPI is orange on the screen. Here you go. This is the key here. So do you see how the white is the 30-year yield and the orange is the CPI. You see how the like for CPI to really get cured back here in this late 70s, um, the after CPI broke above the 30-year yield, the 30-year yield had to overtake CPI and it really started crushing it,
Oh, interesting. But that's the
right?
only time it's ever happened.
Not necessarily, right? So we had we had these attempts here that got well, yeah, I see what you're saying. You were like ran away. Yeah, well, that's the only time
Yeah,
we really had
yeah,
runaway inflation though.
yeah.
So like this is why the stagflation is such a unique regime. But look at it over here. Like let's take a look back in 2005, right? We have inflation start to rip. 30-year yield kind of puts it goes over a bit, but 30-year yield breaks up and stays above it. Same thing here. Inflation falls back through the 30-year yield and it falls apart. Inflation, whenever it falls back through the 30-year yield, it just gets shitted on.
Hmm.
30-year yield always stays on top. Look where the 30-year yield is now, and look where inflation is.
Yeah.
Something is going to meet. I don't know if it's at 6, at 5, at 7, at 8, at 12. I don't know. But this 30-year yield is going to go get back above this orange line. It's just what happens over time,
Mm-hmm. Okay.
right? At some point, the 30-year yield is going to be above the inflation rate again. Now, what's working in favor for the 30-year yield is base effects on inflation. So remember what isn't let's simplify what is inflation. Remember what the meaning is. It's year over year. It's measuring the index year over year. So next year, if the index remains exactly where it is today, by next year, this goes down to zero,
Okay. Yep.
right? So long term, we've had excessive inflation. Like if the best way to look at that would be would go like this. Consumer price index here. Let's look at the CPI index on a line chart. This is inflation over time. This is real inflation over time if we go back. See
Mm-hmm.
this?
Yep.
Right? Now, this is not what you see when you look at a year over year, like when you think of 2% year over year, right? And then you see this like negative 1% in 2009 where CPI actually went negative on a real on
It's
a
like one of the very few
not
times that
yeah,
happened.
where it goes negative, right? But you'd think like, oh, it's falling so much. This was 2009. Let me show you.
Yeah, a little blip.
This is what happened. This is inflation, right?
Mm-hmm.
So when you look at this, all this has to do is chop sideways. You have substantially more inflation than you did prior. This is prior COVID,
Yeah. Yeah. The
right?
slope of that curve just increased.
In,
Look
in
at the 70s. The inflation in the 70s. How does that compare? Yeah. It is kind of similar. Well, it's
it is
actually
kind of
more.
in a
The
shorter period
slope.
of
Yeah,
time.
the slope
Yeah,
looks bigger.
in a shorter period of time, it's more right. But what I'm saying is, you see this acceleration here, and then after the 70s, right? Let's go back. So after the 70, let's go at 80. CPI falls off a cliff after 80, right? And goes down,
Mm-hmm.
right?
Yep.
But it's falling and still positive. It's here. See
Yeah.
this? It's
It's
80.
still inflating, but just at a
Right.
slower rate.
Right. So we have prices will stay elevated. If that, you understand what I'm saying, like
Hmm.
just because we have inflation slow doesn't mean like the prices will just fall apart. Things like gas, maybe, right?
The only time they really fall apart is when you get a negative number, right?
Right. That's when they really start retracting from where they were the year before. Remember, for this to come down back to 2020 level, 2020 or pre-COVID levels, I should say, we have to have a lot of negative prints.
That's
2000.
never gonna happen. There's no
Yeah, I don't
way.
think that's yeah, I don't think that's ever going to happen. I mean, that's statistically just
It's
unlikely.
hasn't happened at all
Right.
historically.
Right. Literally, look. And this goes back to currencies cannot be deflationary, right?
Yeah, yeah. The whole crypto theory of deflationary currency that just doesn't work.
And the reason why it doesn't work is you need people to spend the money that they have,
Exactly.
right?
If people know that their money's going to become more valuable, why would they spend it? Why would they buy
Right.
anything?
Right.
The economy would grind to a halt.
Right. And that's what the Federal Reserve really like when they here. So for people that don't know this, hear this out. The Federal Reserve for years were pissed that they couldn't reach 2% inflation targets. They couldn't figure out why. Let's go to inflation. Inflation could all throughout 13 of we couldn't even get to 2%. We could barely stay above 2%. They did for years. They had a problem of not being having enough inflation.
Hmm.
Now they have this, and they're like, "Holy shit, I
Yeah,
don't know what to
but
do."
they're way more scared of deflation than
Yeah,
inflation.
because
Deflation is way worse.
it's way harder to fight. How do you fight deflation of everyone hoarding their money in a vicious cycle?
Yeah.
You have to inflate the shit out of the money supply, and try and basically like you have to basically fuck people into thinking it's kind of like it's like Bitcoin, literally, right? Like everyone is like, oh, there's only 18 million whatever Bitcoins, or I think it's 18 million, right?
Hmm.
18 million Bitcoins. Don't quote me on it. Um, if I or there might be 18 in circulation, there's 21 total, something like that. Regardless, if you tell them tomorrow there's another 18 million Bitcoins that just got minted, Bitcoin would be worthless. No one would hold it.
Yeah.
The whole reason people are holding it because there's only a certain amount that can ever be created. So if you have, let's just say, $1 million in circulation and you own 10% of it, and the Federal Reserve prints another 10 million, right? You're going to be like, okay, there's no point in me holding these dollars. That's the Fed's power for deflation.
Hmm.
Now, when you have inflation, people are people are spending money too quickly because there's no value in holding it at all because it actually degrades as longer you hold it. The Fed has to fight by basically reducing the supply, tightening the financial conditions, making it harder to get access to dollars, so on and so forth. What this chart is trying to show you here is that over time, the 30 year should basically always yield more than the 30 year should have what this is showing you is over time, the 30 year should have a positive real yield. Now, if I might
Yeah,
be able to,
because there has to be a reason for you to buy 30-year bonds. If it
okay,
doesn't even beat
here's the 30,
inflation.
here's the 30 year real. Yeah, let's take this off and let's take a look. This is the 30 year real yield, a max. It went negative post COVID. We're gonna draw a little line in here. So you guys, I don't know how good the quality of this is, so you
Does
guys
this
can
really
see.
only go back to 2004?
Yeah, it's because tips were only invented in like '96 or something like that.
Hmm.
Yeah, they are not that old. This is the real yield though. This is not the bond. The bonds are around much longer. You know what I'm
Yeah,
saying?
yeah.
Okay, so the 30-year real yield, even in 2009, the financial crisis, did not trade negative real yields.
So this is a first.
This is a first because of COVID, but it's back in the positives.
Hmm.
Think about it. You can't ever have offering debt. Who's going to lock up money for 30 years knowing they're going to get a negative real yield in the United States? I mean, in other countries, it's different, but in the United States, no one, nobody. 30 years? It hasn't even been 30 years since 9/11
Yeah.
or the dot-com crash. Think about that.
Yeah,
30
why would
years?
you lock up for that when you're negative real yield?
Yeah. So, like, That's my point. When the reason I was bringing this that other chart up showing you that the 30 year should always trade over the fluctuation of inflation, because the 30 year is always going to yield more. Now, don't get this confused with how you calculate real yields. Remember, we're not the real yields are not the nominals minus inflation. It's nominals minus break evens. So we're not taking 30-year yield minus the inflation rate of 8%. We're
Yeah,
taking
because that's a delayed
that's a
economic
delayed. Yeah.
metric.
So 30-year break even. Let's see. Yep, they're right here. 30-year break even. This is the 30-year break even yield. 2.45. So 245 basis points needs to that's the expected decay of inflation on your 30-year bond over 30 years. So if you own a 30-year bond, it's got to be paying over 2.45 for you to have a positive yield.
Mm-hmm.
Right? That's what this is showing you. But let's get back to CPI. CPI, these are positive real yield, but the 30-year likes to trade above CPI. So those are going to cross again because that's a fluctuation. That 8% is not going to why the reason this says 245 basis points and not 800 basis points is because we all know no matter where you are, you study math, you know that 800 that 8 excuse me, the 8% CPI print's not going to last very long. It's going to fade.
Yeah, exactly.
It's the base effects. Remember the long chart I showed you of inflation? It's gonna peak at some point and chop sideways, right? And you're
Mm-hmm.
gonna it's gonna fall. That's base
Yeah, because
effects,
it's not sustainable.
right? So that's why this doesn't say 8. But well, if you look at the 30-year yield, the 30-year yield is the 30-year yield is yielding 3.2. So from 245 to 327, the difference of those two is the real yield. But like, let's talk about the nominal. This is trading at 327. Inflation's at 8. This is going to get above inflation. Like, let's just say if inflation wants to stay above 5 for multiple years, right? Let's just say that. It's going to chop between 8 and 5 for multiple years. This is going to go up,
Yeah.
right? Because this is going to trade above. You're not going to get a negative real yield on the 30-year.
Yeah, exactly.
So if this goes up, long-term bonds go down continuously. They keep going down,
Mm-hmm.
right? So that's the key. That's what we need to watch out for.
Yeah.
And that pretty much covers our bond section of this. But I wanted to really clarify that the market is really paying attention to rate hike expectations and bond yields. If rate hike expectations start to peak and start to come down, they're pricing in inflation peaking. Now, why would rate hikes peak? Well, if commodities peak. Remember, rate hikes aren't just going to peak because they think Jay Powell's feeling a special way.
Yeah, it's more to it than that because
Yes.
they can't control the future. You know, they
Right.
control the current rates. But other than that, there's a lot that's out of their control, and
Right. And
commodities
like
being one of them.
the 30-year is at 3.28. I mean, this can very well go a lot higher. The reason why it hasn't gone a lot higher is because everyone's unsure. The bond market's unsure if inflation's peaking or not. But it's holding up enough to tell you that inflation hasn't peaked yet.
Mm-hmm.
But it's not continuously ripping. Well, it was prior to the Fed meeting, right? We made new highs. It's not continuously ripping because we haven't seen a new all-time high in commodities,
Yeah. Well,
right?
I think we really beat the dead horse on this one. We really want to reiterate all of this. You know, the inflation, real yields, all of that we've been talking about for the past few podcasts, because this is a big trade that's gonna be presenting itself pretty soon, hopefully pretty soon. Depends how much inflation sticks around, but the bond trade, it's literally going to be like the trade of a lifetime. So we want to prepare you guys. We want to make sure everyone understands what's going on with it, because it is a dangerous game. You know, if you try to buy this too early, like a lot of people have, you're gonna get smoked. And
So many people stuck in TMF from the 15s, man.
yeah, exactly. And we really want to beat the dead horse on this one, because this is going to be the play coming up.
Right.
So But I think that's enough talk about that
Yeah,
for
yeah, it's
now.
enough about
We
bonds.
had a question um, about the Japanese yen, so let's get into
Yeah.
that.
So let's look at the dollar real quick, right? This is the whenever you talk about forex, foreign exchange currencies or whatever it is, and especially if you live in the United States, always look at the dollar. First thing you do. Why? Because it's the basket of all the currencies. So let's look at the dollar. Dollar's still elevated. Dollar's not even at lower vamp yet. Dollar's not even at mid vamp yet. Dollar's still above mid vamp. So dollar's still looking real strong. Why do we look at the dollar? We have to understand the dollar. Remember, the dollar is a basket, and three components of that basket make up over 83% of the dollar. Number
Hmm.
one being the euro at 57.6%. Number two being the yen, which we're going to talk about at 13.6%. And number three being the pound at 11.9%. So all those combined is over 83%. So when you look at the dollar, strong dollar means weak euro, weak yen, weak pound. That's what that is, right? Because if 83% of the dollar is those three components, and the dollar is really strong, well, what are those three components going to be? They're going to be weak, right?
Yeah,
That's just math. So let's look at the yen. And this looks like a nuke. This thing looks terrible.
it's not
Look
looking
at
too good.
actually Bitcoin looks better than this, but we'll talk. That's terrible. But this is trading. The yen is just floating above the 2002 lows, and it's down about 14% year to date. Now, what does this
That
mean
is
for the dollar?
brutal for a currency being down
That, yeah.
15%.
What does this mean for the dollar? Right. That's the question. That's what the individual asked in the chat. Well, this is extremely dollar bullish, right?
Hmm.
Remember, this falling apart, dollar bullish. Now, remember, it's 13% of the dollar index. So if this starts ripping vertically, it's going to be dollar bearish. It's going to be a bearish component to the dollar,
Yep.
or bearish component for the dollar. This falling is a bullish component for the dollar, and its collapse will only continue to help the dollar. The BOJ came out last week, and they reaffirmed. Okay, the key word here is reaffirmed that QE and their unlimited yield curve control will in fact continue with an 8-1 vote where they maintained its policy rate of negative 10 basis points and kept the 10-year Japanese bond yield target at 0%.
So what does that mean in English?
Let's simplify that. What the BOJ came out and said, remember the keywords reaffirmed, they basically solidified their stance that they're going to continue QE and yield curve control.
So
Basically,
they're
what
going to
that
continue devaluing their currency.
yes, yes, and they're going to continue with yield curve control. Let's talk about that with the yen. I mean, with the Japanese 10-year yield. For years, this is traded within, you know, 20 to
Yeah, it's
0
been it's been
flat.
negative. It was negative
Negative
for like
for a lot. Yeah,
six
a lot.
years.
Yeah. Um, Now, what does this mean? Well, this is the Japanese yield curve control. What does your yield curve control mean? Whenever this 10-year yield rises up, the Japanese purchase an unlimited. They basically just keep printing until it comes back down.
Wait, what?
Literally.
They
Yeah.
just print
Buy they
money,
buy they
or
they
they?
buy bonds on the open market with printed money until the yields fall. They are the
Wow,
ceiling. They are the ceiling in this thing.
wow.
Okay, so now let's talk about this. You want to see something really funny? It's really not funny. It's sad to joke about because these poor Japanese people, man, they're getting gate 15% a year, like just terrible.
Yeah,
Um, uh,
yeah. You literally cannot save money. It's getting deflated faster than you can save it. I mean, inflated away.
all right, you're not gonna want to see this. You're not gonna like the sights of this one.
Jesus,
That's their balance sheet. That's the central bank's balance sheet.
holy
They are
shit.
close to a quadrillion.
That's insane. What's that gonna look like on TradingView? Is it gonna be a queue?
I hope so, because that would be dope as fuck. Oh
I've
no,
never
it's just
seen
a
that.
thousand. It's just a thousand. It's just a
Ah,
thousand.
come on.
Yeah, yeah, that would be crazy. But yeah. So that's what that is.
That's
Uh, we're at
wild.
s- we're at 730. Mind you, the United States is the United States. It's where the Bank of Japan was in 78.
Mm, wow, that is insane.
So when you say you can print a currency, like when they say, "Oh, the debt's too high," I think the Japanese the Bank of Japan spends like 28 trillion a year servicing their debt at 0%,
That's insane.
right? They physically This is when you say you can't raise rates, this is a problem where you raise rates. This is like where it implodes. This is a country that they cannot raise their rates to like 5 or 10%.
Yeah, they cannot. Like if so what happens if they do raise rates?
Well,
They just
remember
can't service the debt anymore?
well, remember how this is very important to understand how government finances debt. The way that they finance the debt and work with their balance sheet is they issue bonds, and the bonds are issued at a fixed rate unless they're tips, right? Those are variables based on the CPI, the basket of CPIs, whatever type of pricing structure. It's usually on it's priced off of CPI, but regardless, those are fluctuating yields to pay off for inflation. Not regular bonds are fixed. So if I issue a bond at 5% for 30 years, when that if let's just say I raise rates to 30% in between, I'm still paying you 5% on that bond.
Yep.
So all this money issued at zero would be fine. It's You see how this keeps climbing by the trillions? I mean, we're talking about this is
Well, yeah, so they're going to
from
have to issue more at a higher rate to keep it going.
well, what I'm saying to you is if they can raise the rates to 10% if they wanted to. The problem is this spending plan goes out the toilet. This goes pretty much sideways, or even, I mean, if they're raising rates, this is going to get reversed
Hmm.
because they're going to suck money back in. Because, I mean, who wants to hold a Japanese bond? Like, let me tell you something. Do you think that, where is it here? I'm sorry, Japanese. Do you think that at any point here this was positive real yield?
No. There's
You
no
just saw their
way.
balance. Yeah.
Like devaluing a currency 15% in a
There's no
year.
real yields here. There's no real yields here.
Hmm. Wow, that's wild.
So
Okay, and that's
so
bullish for the dollar.
that's bullish for the dollar. But like, why would you hold a Japanese bond, right?
Hmm.
So do you know how much pressure is probably here? Who is buying these bonds? Do
So
you know
it's
who's buying these bonds?
just the
The Bank of
government.
Japan, just
Yeah,
the government.
that's wild. I didn't even know that.
They're basically locking themselves in for 10 years taking L's. Like, not even joking.
They're just locking and taking
Think
L's.
about it. Think about it. You think that inflation's obviously over 20 basis points a
Hmm.
year for 10 years,
Yeah,
right? So
that's wild.
if that's the case, I mean, let me see. Will it show me on here? Yeah. Look at this. Japan's inflation rate's at 2.5% right now, year over year. Let's put a line at zero just to give you an idea. This is just rough. Look how look how far. Actually, no. Let's do 20 basis points because that's where we've been. There's no real yields here. There's no positive real yields here,
Hmm.
right? Maybe here, dude. Literally from 2000, all of what are we were talking about 2016, right? They were down to 20 basis points, 2016. There's no positive real yields there. Who wants
Yeah.
to buy Japanese bonds? Japanese government's the only people buying these. I mean, I'm sure there's some people doing it, but whatever. The main buyer of Japanese bonds is the government
Hmm.
because it's a joke.
Okay,
Now,
well let's move on to the next topic. We had another question about crude oil and the
right.
markets right now, how they move in tandem, kind of.
Yeah, so let's go over this, and then I do want to talk about the ECB. You know what? Let me talk about the ECB real quick.
Okay.
This is the reason why I need to talk about the ECB real quick is we're gonna finish up this bond topic. I know we spent a lot of time, many weeks on this, but we're gonna wrap this up, and we're gonna go lighter on this bond topic going forward because it's just we don't want to be too repetitive, but we just want to make sure that you guys have a good grasp because this is such a deep pool that you need to understand a lot of things to get your head around it. But let's talk about the ECB. So remember the euro. The euro is 57.6% of the dollar, right?
Hmm.
And the euro, this is such an important part of the dollar because of its weighting, right? It is so big that it matters so much. Um, this is the euro, and let's pull this up. Um, so the euro is between 2017 and 2020 lows. Okay, the euro, the problem that we have with the euro is it is a currency for many countries, meaning Greece uses the euro, Italy uses the euro, Germany uses the euro, France uses the euro, right?
Yeah.
Now, do you think the production the productivity in Italy is the same as the productivity in maybe Germany?
No, definitely not.
Right, but they all fall into the problems of the same currency.
Hmm.
So, an implosion of the euro would be it would probably put the dollar at new all-time highs.
Yeah.
That's what you need to be watching. The euro going to the yen going to shit, but that's been going to shit for 30 years. It's garbage. It's been garbage. God bless the people that hold yen. They probably don't even hold yen. They probably just switched to something else, to be honest with you. Um, but euro implosion is you're talking about dollar will be worth the dollar will be worth like gold pretty much because 57% of it's the euro. So the euro falls 50%. Just think about what's going to happen to the dollar. If the euro goes to 50 cents on the dollar from here, which I mean, it came since 2011 it was 150. Now it's at a dollar.
Yeah,
Could
it's
it go to a
almost
dollar
at
50?
par.
It's almost at par. Now it goes to a dollar 50. Just think about what happens to the US dollar. It goes up. So that this is
Hmm.
what I would be focused on Europe. If you're worried about forex and you're worried about the dollar's relationship to other currencies, focus on the euro because the problem is the ECB is faced with the same issues as the yen was 30 or 40 years ago. The BOJ, the ECB, not the yen, I'm sorry. The ECB, which is the European Central Bank, is faced with the same problems the Bank of Japan was faced with 30 years ago. And they're going down the same path the yen is. They're talking about coming up with these different tools to fix problems in different countries. It's all QE. It's
Like
all
it's
inflation.
they're just gonna do yield curve control and.
Their only tool is inflation.
Hmm.
You think about it. You can't think about how retarded. I don't want to use the word retarded because think about how stupid this is. I don't want to upset YouTube. I don't need them to give us strikes now. We're so early in this.
I don't think their algorithm even knows we exist.
Probably not yet, but um, you have a currency. If you tighten one currency, you're tightening the currency for all these countries at once. You can't do that.
Yeah.
You can't. It's easy to stimulate all the countries at once, right? That's why the euro has been having this. It's been going down because they could just keep stimulating. Everyone's having a good time. But when time comes to tighten, they're not just tightening France. They're not just tightening Germany. They're tightening everything, all at once, no matter what situation. And they got to tighten everything till They got to watch everything and tighten all at once, right? They can't tighten and be like, "Oh, Greece, I'm sorry, you're feeling a little pain. Let's pull back." But France needs to be tightened. You can't just do. You see the problem? That's the
Yeah.
problem we have. So that's the problem with the euro. This is such a big component of the dollar. This is what I'd be paying attention to, especially now that we're almost trading under par. That's something we need to watch. We're gonna watch this in the coming weeks, months, and hopefully years as we do this. This is going to be a big thing to watch as the dollar is going to be more a bigger in play. But we're going to go back to ES and crude. But I hope we cleared up that whole yen. Those yen questions, those forex questions. If you have any other questions, guys, you know who you are. You're asking these questions. Ask more in the pit. We love answering these questions. That's what we're here for. Um, so let's talk about the S&P and crude. If you look at this on like a 15-minute chart, we're going out I don't know 10 days, right? Um, it's going to look like it's very correlated,
Yep.
right? You're going to see, oh, why is this happening? And there's one real thing for this. on a short time frame, algos run off of algos run Nasdaq or NQ futures programs off of crude. And I have ES up, but let's bring up NQ because it's probably look a little bit better. It looks a little bit better, right? It looks
Mm-hmm.
a little more in tune. That's because when crude really starts dipping, crashing hard, most of the time here, when you have this panic selling, they puke Nasdaq at the same time.
Oh,
Okay.
interesting.
Now, and when you have these huge bids, you'll see them run together. You see this? It's not going to be completely synonymous, or synchronous, but this is the normal short-term price action. And the reason they do this is because crude is also a growth as much as a fall in crude is a sign of deflation, right? A
Yeah.
crack in crude is a sign of slowing inflation, right? Um, More importantly, a crack in crude is a sign of economical problems. Crude falling means that either there's just more and more supply than there is demand, or there's a demand problem. And that's not seen well for the markets. And that's what these algos play off short-term price fluctuations. They think they can basically structure their systems to trade intraday along with crude. If we go on a longer term chart, you see that these things don't really line up too much. Now, why? Well, this goes back to the regimes. This is the importance of the system. If you do not know what the system is and you've been following us, if you're new to the channel today, this is your first video, go on our website, sign up. It's completely free. We give the system away for free. You can see real time what the market's pricing in. That is the most important thing, because the only regime that crude statistically performs negatively in on a month over month basis is deflation. That's it.
Yep.
So let's and you can see we have a regime on our website here. If you go under the regimes tab and you scroll to the bottom, we have the historical regime data. Under crude, you will see that the only regime that it's negative is deflation. It's positive in all the other regimes. It does best in inflation, but it still does decent in stagflation and in expansion. So what is this telling you?
It's
This
like
is telling
it's a strong deflation proxy.
it's a strong deflation proxy. But also, crude going up doesn't mean like it's going to be in line with the Nasdaq going up, if that makes sense.
Mm-hmm.
Because, like as I just showed you, there's three bullish regimes of all different performances. If I gave you a regime of inflation, crude is going to line up more with the markets ripping than it will in another regime.
Yeah.
So it's very important to understand the regime that you're in, because the regime that you're in will dictate what is going to happen in the regime that you're going, or the performance that you're going to experience. Meaning, if you're in deflation, don't own crude. If you're in expansion, there's better alternates. If you're in stagflation, there's better alternatives. If you're in inflation, things great.
Yep.
So you really want to own crude in inflation. That's the best. Now it works in stagflation, but this goes back to us telling you that stagflation is a precursor for deflation. Usually stagflation is not this long. If you look back in time, stagflation is usually followed by harsh deflation regimes.
Yeah.
It-
Historically, stagflation play is longing bonds because you get deflation right after. So
yeah,
bonds tend to start performing well
right.
even in stagflation because the market's starting to anticipate deflation coming.
And that's the only reason we didn't get that this time is we have this sticky inflation problem, which we go over. We went over that a few podcasts ago, but that's a good point. And let's pivot that into the last point here of SPY and TLT. If we look here in SPY and TLT, we had this deflation pivot in 2018 or 2019, and both went up, right?
Mm-hmm.
Both went up all of 2018, all of 2019, pretty much. Except bonds outperformed SPY, but they both went up. Now, can they both go up again? Is the question. Can they both pivot and go up again?
That doesn't happen often.
I don't think so. And this is you're right. It doesn't happen often. I don't think that will happen. Meaning, my premise for asking that question is, if the Fed pivots everyone's saying the market's going to go up, right?
Yeah, it's the exact opposite.
No, no, no. Well, no, no, no. Yeah, yes, and no. But if the Fed pivots, they're going to be cutting rates. That's a pivot, right? Instead of
Yep.
hiking, they're cutting, which means bonds will go up, right? And technically, yes, you're right. The market will go up. But that would require the Fed to pivot for bonds to go up. They would have to cut rates. And remember, cutting rates is stimulating the economy. Does this economy need to be stimulated right now?
No,
No.
definitely not.
And that's why we're a long way from rate cuts with this inflation situation. That's
Hmm.
why. So conditions are going to have to tighten. Meaning the best case scenario is bonds chop. They don't even, let's say bonds, let's say we have to tighten and we have to hike into expectations, meaning the bond market's not going to really price any more rate hikes. It's already gotten demolished, right?
Hmm.
This is where this whole chop we spoke about a couple of podcasts ago. Let's go back in time. This. See this?
Yeah, that's pretty
Uh
likely.
this here. This is like this whole area here, this congestion, this is likely.
Yeah.
Giving Momo enough time to catch up, and then we get the pivot. Then we get this thing. Because this is coming again. If you don't think the federal funds rate's going to trade back under 1% again, it's going to happen.
It's gonna
They
happen.
can't
It's gonna happen quick. When
they
it.
can't they can't stay away from zero. Unfortunately it's like a substance abuser. You get them off the substance, right? You bring them they go to AA meetings, whatever. They're doing great, and you find them again 2 months later, right? You need the willpower. The Fed has no willpower. They're like dope addicts coming back for another fix. They,
Yeah.
they, they cannot help not being at 0%.
Yeah. So we are going to get back there.
We're gonna get back there at some point. The Fed might have to do things differently because they don't want this problem again, but I can't see that they're wimps. The sign everything gets tough, people need it easy. They're gonna cut. Unfortunately, us as humans have been weaned off of feeling pain.
Yeah, it's been a while.
We don't want to feel pain. We're gonna feel pain now with this inflation thing, but the Fed's always gonna try. They're gonna find a reason or a way to navigate. And I think that's where we're gonna finish off today. But I just wanted to cover those topics and make sure we get over with this inflation. We're gonna try and introduce some new topics next weekend to broaden your knowledge base because you guys are probably all filled to the brim with inflation and rates by this point. We're gonna
Which is
expand.
important. Like
It's
it
important.
honestly it runs the world. Bonds run the world.
They
So
do.
you have to
They're the
understand
biggest.
them.
They're the biggest asset class. Their second biggest asset class. The first one being real estate. So yes, they do run the world.
Yeah.
They're the most important thing. And we hope that you guys have gotten a great understanding of bonds and a great understanding of how this all fits together. The puzzle pieces connect. Because just looking at yields, if I were to show you the yields quotes, you would be like, "Oh, this doesn't mean anything." But it's putting these yields together with the bonds with the inflation expectations within the regimes. That's how all this gets pieced together. As long as you understand that, we're going to go into deeper and more I should say, more pivotal topics that we can talk about time to time and basically tie this into even a greater or even a bigger picture. So we're going to leave this off here. If you have any questions, hit us up in the Discord, hit us up on Twitter. If you haven't already, go to www.market-radar.com and sign up for our system, access to our system. It's free. And we hope that you guys get as much out of it as we do. And we will see you in the next podcast.